We are entering this phase where you are seeing the air come out of the crypto bubble. You are seeing the air come out of the AI bubble. You are seeing, private credit start to hit the wall. So I think if you're very exposed to these asset classes, there is actually a lot to worry about. For me, AI is probably the most important one, because that's really driven equity market valuations. We've gone from a 40 trillion market cap in the US 3 years ago to a 70 trillion market cap for the US.
Hello everyone, and welcome to another edition of Triangle Investor Interviews. I'm your host Lucian Valkovic, and before I announce my guest, just a quick reminder of a disclaimer. This interview and all my interviews are not a recommendation to buy or sell any shares, products, or services. Always do your due diligence and consult with your financial advisor. I'm joined today by Louis-Vincent Gave, economist, geopolitical analyst, investment strategist, and co-founder and CEO of Gavekal Research, one of the world's most respected independent macroeconomic research firms. I'm so happy to have you in my show, Louis. Thank you very much for joining me today.
Thanks for inviting me, and thanks for the kind words. Very much appreciate it.
No, thank you once again for coming. We have a lot of things to discuss. I really, just like I said before we hit the record button, I like your approach. Really like your interviews. I watch them regularly. So basically, I don't know where to start. We really have a lot of things to cover, but maybe we should start with the thing that is probably the most interesting for the retail, not just the retail, I mean for everybody, and that is market crash risk. A lot of people are terrified of 2026 stock market crash. How high is the real risk right now to you, and what could actually trigger it? I mean, how do you assess the current stock market today? Let's start with that.
Sounds great. And you're right, this is probably the single most important question. So look, it's always weighing risks with opportunities, right? Now, I think when you look back through past cycles, usually bad things tend to happen to economies, bad things tend to happen to markets, either when the cost of capital goes up, i.e. interest rates move much higher, or more importantly, the cost of energy moves up. One of my core beliefs is that economic activity is energy transformed, and also that most businesses, most entrepreneurs can withstand one punch. So if you think of like higher interest rates as a punch to the face, most people can take a punch and then stand back up. It's when you get the second punch that you end up being lie down on the ground. And so for me, the typical 1-2 punch combination that I'm always worried about is higher interest rates and higher energy prices. Now, to be very clear, today, energy prices are pretty low, very low, everywhere around the world, and interest rates are also very low. So that on that front, on a pure fundamental basis, that doesn't seem like a backdrop where you'd have to worry too much. Having said this, so this is the good argument, and I don't want to be like a Truman two-handed economist, but the bad argument is that you've probably had a lot of capital deployed in recent years, partly because the cost of capital was too cheap, capital was too available. You've had a lot of capital deployed in fundamentally unproductive means. Whether in crypto, whether in I think everything linked to tech and artificial intelligence, and frankly in private equity and private credit, a lot of capital was deployed on the premise that very high returns would be achieved. And we're now reaching the point where we're realizing that these returns were an illusion. That private credit is not going to be returning 15% a year. That private equity is not going to be returning 15% a year. That AI may not, return multiples of the money invested. Neither will crypto. And so right now, I think we are going through a reassessment of what the real return profile for a lot of these asset classes that have attracted hundreds of billions of dollars. And and so the risk, I think, is very much there. It's not as much a fundamental risk as a risk of, look, for 10, 15 years, we had too low a cost of capital. Capital was misallocated, and now needs to be repriced. And I think right now we are entering this phase. We are entering this phase where you are seeing the air come out of the crypto bubble. You are seeing the air come out of the AI bubble. You are seeing, private credit start to hit the wall. So I think if you're very exposed to these asset classes, there is actually a lot to worry about. For me, AI is probably the most important one, because that's really driven equity market valuations. We've gone from a 40 trillion market cap in the U.S. 3 years ago to a 70 trillion market cap for the U.S. It's really driven a lot of recent years. And I think for a while, as you see very often in bull markets, especially bull markets linked to capital spending, what you saw was a period where, in the up, it's always the same story with markets. In the up phase of the bull market, you get rewarded as a company for deploying capital. You get rewarded for spending money. And then comes a time where the market starts to say, hold on, where's all this money going to come from? And then you get rewarded for actually getting rid of the assets you overpaid for in the bull market. And you just witnessed this. Look at Oracle. What was it, 6 weeks ago, maybe 2 months ago? Oracle came out and said, I'm going to spend $300 billion on data centers. And the market loved it. Like the Oracle share price goes up 20%. It's like, yay, party, amazing. And then within a week or two, the market's like, hold on, where are you going to find $300 billion? And so the CDS spread, basically the cost of funding for the Oracle debt, starts to go up. And then it starts to take up all the other guys as well. The cost of funding for Facebook, the cost of funding for Google. And so now we've entered the phase of the cycle where companies are no longer rewarded for just announcing capital spending plans. Now they're being asked, hold on, how are you funding this? And you've seen this with SoftBank. The SoftBank share price is down 40% in the past 4 weeks. You've seen this with SoftBank in Japan. You've seen this with Oracle in the US. So I would say it's a long-winded answer to your question, but do we risk a broader crash? I still don't think so. Is there a big risk on AI, on crypto, on a lot of the private credit, private equity? I think absolutely there's a big risk.
Yeah, great answer. Agreed 100% with everything you said over here. But that imposes the second question: where to invest? If we really see the big stock crash, which assets will protect people best? Gold, commodities, cash, something else? I know that you've said that in the world of persistent deficits and deglobalization, gold is the only true natural reserve asset left. So but on the other hand, we have gold 4,300 today. Is gold still a buy, or has the trade become too crowded? What's your take?
The trade is crowded, but it doesn't mean it's wrong. And you could have made a case that tech was crowded 10 years ago, and it still was the trade for 10 years. So you look at gold. When I look at an asset class, first thing I start with is the fundamentals. Does this make sense? Does a rise make sense? And when you look at gold, the fundamentals make sense. It's, you've got the big budget deficits that you highlighted. Perhaps more importantly, gold in my book isn't a hedge as much against inflation, which is what most people believe, but gold fundamentally is a hedge against low interest rates. And incidentally, you've seen this in recent years. For all the rise in the gold price, it's not Europeans, it's not Americans that have been buying gold. It's Chinese and Japanese. You look at the gold flows, it's all been, it's been the central banks buying on the one hand, and Japanese retail and Chinese retail, which happens to be where you have zero interest rates. So, if you start to think, okay, we're going to have a hit on private equity, we're going to have a hit on private credit, we're going to have a hit on AI, how do I hedge this? What's likely the destination for short-term interest rates in the Western world is, the central banks will cut interest rates. And that will likely mean gold becomes more attractive. So the fundamentals are there. The momentum is there. The third thing I look at is valuations. Now, gold is expensive today. There's no doubt about it. But, so logically what you should see, cost of getting gold out of the ground is 16, 17, 1800 bucks. Cost of selling gold is 4,300. So gold miners should be out there either selling their production forward or just getting more stuff out of the ground. The reality is they can't. They can't. They've spent 10, 20 years looking for more gold in the ground, which is why they've been pretty poor investments and not finding it. So, if you're sorry, I just lost my earpiece. If you're in an environment of such price differential between cost of production and sales, logically, that's the valuation argument. Like production should go up, but it's not happening. And then you look at the investor positioning. To your point, is it a crowded trade? And look, very few institutions still have meaningful exposure to gold. Yes, central banks are buying, but you look at things like share outstandings in GLD, share outstanding in SGLD, the biggest gold ETF in Europe. The shares outstanding are not at all-time highs. We're still below the highs made 3-4 years ago. So I think, look, gold is one way to answer your question. Gold is one way to hedge that risk, but there are others. Look, I think what we know of bull markets, and here, somebody like John Kenneth Galbraith did some great work on this, on the concept of the bezel, the concept of a bull market lasts long enough, you start to see big capital misallocation, you start to see frauds, etc. Well, the U.S. bull market's been going on 15 years. It's the old story of Warren Buffett of, when the tide goes out, you see who's swimming naked. I think what you're starting to see in the U.S. is the tide going out on some of the more frivolous trades. Again, crypto, AI, private equity, private credit. And as the tide comes out, you're starting to see who is swimming naked. And
That's a good analogy.
yeah, and now the reality is in most other markets, whether Europe, Japan, China, they're not in a 15-year bull market. The bull market is like 12 months, 24 months. The frauds in China, the frauds in Japan, the frauds in Europe were revealed in the previous bear market. We haven't had time to build up new frauds yet. So I think today it's actually a lot less risky to be invested in China, to be invested in Latin America, to be invested in Japan or Europe, because you've uncovered already all maybe not all, but you've uncovered a lot of the dirty secrets, and the dangerous plays have already been found out. I think in the US we have that to look forward to. So yes, the way I look at it is the U.S. today is 70% of the world MSCI. It's roughly 22% of global GDP. This is a divergence such as we've never seen. When I look at the world of tomorrow, what is going to be the big growth trend of the world of tomorrow? I think the big growth trend is actually going to be the integration of the Eurasian continent through rail, through transportation, it's going to be, China doing more trade with Russia, doing more trade with India, doing more trade with Central Asia. And most U.S. companies are not exposed to this. So it's, I think you can own a lot of equities, a lot of places, even in an environment where AI blows up or U.S. private credit blows up. On a long-term view, these should still do fine.
Yeah, you mentioned China. I want to ask you about China. The US started the trade war, but is China actually winning it right now? What's your take?
To be honest, I think it's wanted, yeah. Now, it's wanted, yes and no. It's wanted. Look, the first thing I'd say is in a war, the winners are usually the ones who don't participate. The best thing you can do in a war is avoid it. Now, to your point, the U.S. started the trade war with China. You'll remember that Donald Trump said trade wars are easy to win, etc. But I think when you have the boss of Raytheon that comes out and says in 3 weeks we can't produce missiles, and Ford shutting down factories because they need the magnets and they need the rare earths that come out of China. And when you have a meeting in Seoul, like you just had, where between Xi and Trump, where the entire topic of conversation is TikTok and rare earths, which are in very much two topics in which China holds all the cards. Because when it comes to TikTok, like Xi Jinping doesn't care if the U.S. shuts down TikTok. It's like, he's not a shareholder in TikTok, in ByteDance. He doesn't care. And when it comes to rare earths, it's essentially the U.S. having to come in and plead for access to rare earths. So, the trade war started 7-8 years ago. Trade war was actually the wrong term. It was really a tech war. What the U.S. did was tell China, we're going to ban you from getting access to high-end semiconductors, and in this way, your economy is not going to be able to grow. And you fast forward 7 years, China's trade surplus has moved from 20 billion a month to 100 billion a month. China is now exporting cars, turbines, nuclear power plants, when it used to export T-shirts and tennis shoes.
Yeah.
And now the U.S. is in a situation where it is forced to back down on all of its threats against China. So essentially, 7 or 8 years ago, the U.S. could put a lot of pressure on China, and China then spent 7 or 8 years de-Westernizing its supply chains at great cost, which goes back to the very first point I was making, that the best thing to do in a war is to not fight. When the U.S. put its embargo on China, and China decided to de-Westernize its supply chain so that nobody could put pressure on it, this came at great cost to China, enormous cost. The stock market went down 2/3. The real estate market went down 1/3. Consumption was crushed. The birth rate halved. Like, China took a lot of pain, economic pain, financial pain, to get to where it is today. And so today, the shoe is essentially now on the other foot,
Yeah.
and China can now put pressure on the U.S. And so the U.S. is now at a crossroad, I think, where the U.S. can decide, okay, we're going to de-Sinify our own supply chains. We're going to build our own aluminum industry. We're going to build our own shipping industry. We're going to build our own rare earths and our own magnets and all these things. But let's not kid ourselves that this doesn't come at a massive, massive cost. It essentially means reallocating tons of capital in industries with much lower returns on invested capital. Now, the U.S. would be doing this at a time when it's running twin deficits of 12% of GDP. It would be doing this at a time when government debt is already 120% of GDP, and when the budget deficit is 6% of GDP. So it's like, you're going to have to reallocate capital in the way that China did. For almost 10 years, China said no money to real estate, no money to the stock market. Everything's going to go into industry. Now, I don't think the U.S. can do this, because the U.S. is a much more financialized economy. It's also starting from a higher debt level situation on all levels. When China did this, consumer debt wasn't that high, government debt was very low. So China could afford to do this. I'm not sure that the U.S. can, and politically, it definitely can't. Politically, this would be suicide. To say, look, the real estate market is going to go down 1/3 and stocks are going to go down 2/3. Yeah, you'll have revolutions in the street. So the U.S. is at this crossroad where essentially it can say, okay, we're going to follow the same road plan that China followed the past 7 or 8 years, option one, or option two, we have to get along with China. And I think, President Trump rightly has elected to go down option two.
Yeah, how will the US dollar react in this kind of environment? I mean, this geopolitical and trade chess game, if I may call it, how much life is left in US dollar?
So look, I think the US dollar has started a bear market. First of all, I think we have to acknowledge that you have an administration today that does want a weaker dollar. It's pretty obvious in everything they say, whether Scott Bessent, whether Donald Trump, they want a weaker dollar. Now you could say, yeah, that's fine, but they don't have control of the Fed, and the Fed dictates policy, which eventually dictates the dollar, which is true. They don't have control of the Fed for now. This is going to change in the next 6 months. Trump's going to appoint his own governor. So, when you have, when you have a government that wants a stronger currency, it doesn't mean you'll get a stronger currency. But when you have a government that wants a weaker currency, more often than not, it's getting a weaker currency, because the way the world works, it's easy to weaken a currency. It's very hard to strengthen one, but it's easy to weaken one. So I think that has to be your starting point when you look at the dollar. You have an administration that wants a weaker dollar. So from there, if you want to be a bull on the dollar, you have to make a pretty strong case. It's like, what's going to be strong enough to counteract that? Now, when you look at the geopolitics of everything, when you look at how, again, China has just won the trade war, when you look at how most of the global growth in trade is increasingly happening in emerging markets, that's where the growth in trade is happening. And increasingly that trade is happening in non-US dollars, which of course was the big lesson of the Russia-Ukraine war and the sanctions we imposed on Russia. When we imposed sanctions on Russia, we being the Western world, I say we because I'm French, we being the Western world, when we imposed sanctions on Russia, essentially we said, we're going to cut you off the dollar, the euro, the pound, the Swiss franc, and you're going to be unable to fund your trade. In any event, within 3 years, Russia trade with China had tripled. Russia trade with India had tripled. Russia trade with Brazil and South Africa had tripled. And all of this was funded in other currencies. So all of a sudden, we found out that actually you could fund trade in other currencies from the dollar. And in most emerging markets, there is a desire to reduce dependency on the dollar. Maybe not for geopolitical reasons. Maybe not, oh, we don't like the US, etc. Simply because if you look at the past 30 years, you've had a number of crises because dollar was made unavailable to emerging markets. So if you're at Thailand, Indonesia, 97, 98 American banks don't want to lend to you anymore. Your entire economy implodes. You wipe out your entire middle class. 2008, because U.S. banks, got overextended on domestic mortgages, they all of a sudden, Korea can't trade with Indonesia because that trade can't get funded. So there is, I think, a desire within emerging markets to reduce the dependency on the dollar, because that dependency on the dollar leaves emerging markets very vulnerable. And now all of a sudden there are other opportunities. It's like, oh, we can trade in local currencies, and at the end of the year we settle in gold. We can trade in renminbi. We can trade in Brazilian reais, like lots and lots of things. So bottom line is, the way I look at it, the U.S. current account deficit has never been this big. The U.S. is sending more money abroad than ever. And it's sending more money abroad to the rest of the world that increasingly will need fewer dollars. So yeah, I think the price of the dollar is heading lower.
Again, great point. We didn't touch on Europe. European equities have dramatically underperformed the US for the last 15 or plus years. Is the valuation gap finally justified, or we are on the verge of the biggest regime shift in relative performance since the early 2000s?
So first, everybody's underperformed the U.S. in the past 15 years, not just
That's
Europe.
true.
Not that I'm defensive about it, but it's, the U.S. has been truly outstanding for 15 years. Europe was bad, but in essence, so was a lot of other places. Look, I think the main argument for there's two bullish arguments for Europe, but there's a lot of bearish ones. The bullish ones are, one, it's not very expensive, and two, when emerging markets do better, Europe tends to do well. Like I've always looked at Europe as a sort of derivative, low beta play on emerging markets, because we do have a lot of world-class companies in Europe, the Siemens, the Air Liquides, the Schneiders, the LVMH, etc. of this world, that tend to sell disproportionately to emerging markets. And so when emerging markets do well, all of a sudden we get this acceleration effect in Europe. And we get it on two fronts, incidentally. We get it because emerging markets, we sell stuff to emerging markets. And then when people get rich in emerging markets, they turn around and very often they come and spend their money in Europe. They buy assets here. They'll buy a house in Saint-Tropez or a house in Marbella. They'll send their kids to boarding schools in the UK. And lots of such factors. So that's the bullish argument for Europe today is, look, emerging markets are doing better. China is being massively reflationary. Interest rates are falling in Latin America. Commodity prices are creeping higher. So lots of reasons to think EM are going to do better and Europe will participate. So that's the bullish case. Against that, the bearish case for me is very much one of massive political uncertainty, in that it seems likely to me that, in the coming quarter, year, the Russia-Ukraine war will come to an end. And then this will leave Europe confronting a very simple choice: is what do we do with Russia now? Um, do we? It will come to an end without having had regime change in Russia. Like if there's regime change in Russia, of course, that's a completely different can of worms. But assuming Putin is still in power, which I think is a fair assumption at this stage,
Yeah.
what's going to happen, I think, in Europe is you're going to have countries like Hungary, like Slovakia, like Germany, like Austria that are going to say, hey, let's do business with Russia again. I like getting cheap energy. I like selling stuff to Russia. Meanwhile, you're going to have countries like Poland, the Baltic countries, the Scandinavian countries that are going to say, absolutely not. These guys are war criminals. We absolutely should never do business with them, etc. So I think you're going to have a split within Europe that is going to be very, very devastating. And I'm not sure politically how we're going to manage this one.
Yeah. Final question, Louis. What's the one big trend you think will completely change the world in the next 5 to 10 years?
Look, I think for me, the major trend that people are forgetting about is essentially the integration of the Eurasian continent. I live in Hong Kong. I like to say that, I actually live in the center of the world, because within a 5-hour flight of Hong Kong, you make a circle, you actually have more people living in that circle than outside of it. And you could say, yeah, who cares? It's been like this all the time. The reason this matters is that when I first moved there 30 years ago almost, 2/3 of the people in that circle were living in the countryside and a third were living in cities. Now 2/3 live in cities. And the reason that matters is that economic growth happens in cities. It's in cities that people exchange ideas. It's in cities that you have universities, that you have factories that develop new processes, that you can start building integrated supply chains. Growth happens in cities. Now, the story of so within that circle, that 5 hours flight from Hong Kong, you have 67 of the top 100 cities in the world by population now. And these 67 cities came out of the ground almost independently. And now you're starting to link them with roads, with canals, with telecom systems, with university exchanges. And this is just starting. There are still no direct flights between Beijing and Delhi, between Shanghai and Mumbai. The capital cities and the financial capitals of the world's most populous countries that are our neighbors don't have direct flights with each other, don't have university exchanges, don't have any of these things. All this is going to happen in the next 5 to 10 years. And so I think this is going to be the big growth driver going forward, especially since politically there is now a real push. You saw it in September in Tianjin with Modi, Xi, and Putin walking hand in hand, hugging each other publicly, etc. There is now a real push for more economic integration, which fundamentally makes sense, because if you look at Russia's business model for 200 years was extracting stuff out of the ground and selling it to Europe. Well, that no longer works. China's business model was producing stuff and selling it to the US, and that no longer works. And India's business model was training very smart people and shipping them to the US, the UK, Canada, Australia, and waiting for them to send money back. And that also no longer works.
Yeah.
So all three countries have to find new business models. Now, when you think of it, Russia today has the cheapest commodities. China has the cheapest machine tools and cheapest cost of capital, and India has the cheapest labor. So if you put all this together in a stew and you mix it up, it makes for a very, very potent combination. And so I think that for me is the big trend going forward.
Yeah. Another smart thing you said over here. I want to thank you for coming to my show. It was a great
Pleasure.
chat, as I really expected, and looking forward to host you again sometime soon.
Thank you very much for having me. Great to be here.